Welcome to Module 20 of Accounting 5000. In Module 20 we're going to cover Chapter 10 of your textbook. We're going to talk about the explanatory notes and the other information that is found in the annual report of most Fortune 500 firms and publicly traded firms. Let's start out by talking about what explanatory notes are. Explanatory notes give you, as an investor or a creditor, information about how the numbers in the four basic financial statements have been computed. They will tell you things like the depreciation method that's being used, how they value their inventory, whether it's FIFO, LIFO, or weighted average. They will tell you how they are consolidating the other firms in their business. They give you information about tax rates, what the effective tax rate is, what kind of foreign taxes they have to pay. They give you information about employee benefits, for example, employee stock option plans, pension plans. They tell you about the amortization of goodwill and other intangibles. And finally, there's usually some disclosure about earnings per share and other stock options that are outstanding. In addition to that, you also have a beginning of the annual report, usually a section that tells you about all their accounting changes. For example, if a company changes how they report a particular type of expense or revenue, there will be information there in the annual report that will tell you about that change. The third one on the list that you see in front of you is a big one. In the annual report, they will also tell you anything about contingencies and commitments. Contingencies being things that might happen that will affect an investor's and creditor's perspective on the future of the company, for example, lawsuits or environmental problems. It also tells you about commitments the company has, for example, guarantees that they have on certain loans, other things like that where they have made a commitment, but it may not actually reflect in the annual report in any place that you could find it easily. A nice thing that you also see in the annual report are things that happen after the balance sheet date, but before they publish the financial statements. Remember, the balance sheet is dated the last day of the year, which in many firms is December the 31st. The annual report usually doesn't come out until March. So in that time between the end of the year and the time the annual report comes out, sometimes important events occur. The investors and creditors will want to know about those important events, so those are disclosed in the annual reports, in the notes, and other explanatory material. One of the things I really like about the information that's in the annual report is what we call segment information. Companies are required to disclose for you where they do their business. In the United States, in Africa, in Europe, in South America. So they have geographic information about where they do their business. That gives you as an investor or creditor a chance to assess the risk that that company has. Some areas of the world are more risky in which to operate than others. In addition, in the segment information, they tell you what the segments of their firm's type of sales are. Do they sell, for example, fast food, consumer electronics, those sorts of things. They will break down their sales by type of sales, type of areas in which they work. For example, if PepsiCo several years ago had fast food restaurants, they had soft drink machines, they had snacks. All of those things had different risk factors to them, so investors and creditors were then able to determine which part of the company was most risky and which was less risky, and help do their analysis looking at the risk factor in addition to all the other things that are in the annual report. One of the things that you will notice when you read through the annual report is that there should be a section where management has assumed the responsibility for the information in that annual report. It tells that this is their responsibility, they have produced this information, they have a good set of internal control at their firm, and that everything is overseen by the audit committee. You will notice as we go through some of the exercises at the end of this chapter that this is not always evident in a lot of companies' annual reports. But because of the changes that have occurred lately, you will see it in almost every report now because of the legislation that's come before Congress. An additional thing that you will notice as you read through the annual report will be what we call the MD&A, Management's Discussion and Analysis. The SEC, the Security and Exchange Commission, requires firms who issue annual reports to include in their annual report some information about the company. Discuss for the investors and creditors what has happened, why it happened, what they expect to happen in the future, kind of discuss the financial condition of the firm. This is very important reading for investors and creditors because often Management can tell you exactly what's going on in the firm, and these are things that can't be disclosed in financial numbers in the actual statements. One of the things you'll also notice in the annual report would be what we call a 5-year summary of financial data. In many firms, it's much longer than 5 years. It can be as many as 10 or 15 years. But at least 5 years will be shown, and it will report such things as total assets, total liabilities, their earnings per share, their dividends, key ratios like debt to equity ratio, current ratio, information that investors and creditors would like to have, and it makes their life a little easier to provide it rather than have it provided rather than having to compute it. Be aware, though, as an investor and creditor, those numbers are not audited. Those numbers are provided by management and have not been checked or verified by the auditors. Speaking of which, the next thing you'll notice is there is an independent auditor's report in every annual report. This is one of the first things I look for when I'm looking at an annual report. I want to see what the auditors thought about the financial statements. Typically, it simply says that the information in the annual reports has been produced according to generally accepted accounting standards, that they have used generally accepted auditing standards to perform their analysis of the reports, and that the information is fairly presented. Doesn't mean it's completely accurate and that there are no mistakes. It just means it's fairly presented in all material aspects. Remember back to Module 2, we talked about materiality. Materiality means there's nothing there that would change an investor's or creditor's opinion. It wouldn't make a difference in their decision. This independent auditor's report will be addressed to the board of directors, and it's typically at the very end or near the very end of the annual report. If anything weird has gone on in the company in the past year, you will usually see an explanation of that in the auditor's report. So a lot of people read that first. I'm one of them. I read that first and then I look at the cash flow statement before I do anything else. Occasionally you will see presented in a company's reports something called a compilation. Be aware that a compilation is not audited. It is simply a group of financial statements that have put together. They do not have the stamp of approval of an audit. It's far less expensive for a firm to have a compilated set of financial statements than it is an audited set of financial statements. But the Securities and Exchange Commission requires audited financial statements. So it will only be the smaller firms, the localized firms, that you will probably see compiled financial statements. Well, let's see what this stuff really looks like. And let's use Intel, which is at the very end of your textbook again, as our example of some of the things we want to look at. Let's start by using exercise 1 in your textbook as our first point of discussion. It says to look at Intel's annual report in the appendix, scan the annual review, look at the independent audit report, the management's discussion and analysis, and results of operations. Well, as you go through looking at that information, you will find that the financial review is on page 625. I couldn't find a management statements of responsibility. Perhaps you're a little bit better detective than I am, but I could not find that. It wasn't evident any place in the annual report. However, I did find the independent auditor's report, which was on page 649 of your textbook. Then there's an interesting discussion of the management discussion and analysis piece there. Starts on page 626 and continues for several pages, but that gives you a real insight into Intel's financial statements. Looking over at exercise 3, it says to look at the independent auditor's report. It is impossible for an auditor to guarantee that a company's financial statements are free of all error because of the cost. It would simply be too costly to go through and look at everything and make sure there are mistakes. The cost of the auditor's verification would be too expensive, so how does the auditor's opinion recognize that it's not absolutely accurate? Well, if you read through the independent auditor's report there, you will see a phrase called, "It presents fairly in all material respects." And we mentioned earlier that the materiality is the key rule there. There's nothing major that is wrong that would influence or change an investor's or creditor's decision. Continuing with that, in question 4 it says, to what extent is the auditor's opinion an indicator of a company's future financial success and future cash dividends to the shareholders? Well, at no point in the audit report does an auditor look at the future. This is a past event. They're looking at things that have happened already. Auditors do not forecast. So you will see no indication in the auditor's report of anything in the future. However, if the auditor does not think the company will be able to continue to go on into the future, there will be a paragraph, which is called a going concern paragraph, which states that the auditor doesn't think the firm will be able to continue in business in the future. In exercise 6, continuing down on page 370, it says during the year 2004, Gluco Inc. split its stock on a 3-for-1 basis. In the annual report for 2003, the firm reported net income of $925,980 with an average of 268,400 shares of common stock outstanding for that year, and there wasn't any preferred stock. The first part, they ask you what was the reported income for that company for 2003. Well, the income stays the same regardless of what the stock split is, so there's no change in their income. It says calculate what their earnings per share would be for 2003 that would be reported in 2003. Well, the stock split did not occur in 2003. It didn't occur until 2004. So they would simply take their net income, there are no preferred dividends, they would divide it by their weighted average number of shares of stock of 268,400. They would come up with an earnings per share of $3.45. Then in Part C it says calculate the earnings per share for 2003 that will be reported in the 2004 annual report. Well, at this point their stock has split. So at that point they have 3 times as many shares of stock, but income remains the same. So in order to have comparable financial statements, in other words, in order to compare earnings per share of 2003 and 2004, you need to go back and restate your earnings per share for the previous year. So you restate it by taking your $925,980 and dividing it by 3 times as many shares of stock, which gives you a third of the earnings per share, or $1.15. Let's look at one more. Let's look at exercise 10, which is at the bottom of page 371 of your textbook. And again, this is an Intel annual report problem where we're going to look at what Intel has done. And they ask you there to look at the 2001 annual report in the appendix and find the 10-year financial summary. Okay, the 10-year financial summary is on page 625. So if you want to look through there, in Part A they ask you what percent of R&D relative to net revenues in 2001. Well, if you look through the columns, you can find the R&D expense, and you can find net revenues. And I got $3,796,000 in R&D, and I divided that by the $26,539,000 in net revenues, or 14% of their revenues were spent on R&D expense. In Part B, it asks you by the amount that property, plant, and equipment decreased in 2001, in other words, for depreciation, sales, and other transactions. Well, you know they started out in 2001 with $15,013. They had some additions to PP&E, because you can look through that 5-year financial summary and you find out they added $7,309. You don't know how much it went down, but you do know they ended up with $18,121. So if you can do your math there, you will find out that they decreased PP&E that year by $4,201,000. They ask you to look at which year stockholders' equity grew by the greatest amount over the previous year. Well, that's fairly easy to discern. If you look down through all those changes, you can see that from 1998 to 1999, stockholders' equity went from $23 million to $32 million, so it went up over $9 million. In D, they ask you for the change in total liabilities from 1995 to 2001. Well, they don't give you that number, so you have to compute it yourself, but you are given total assets and shareholders' equity. Well, remember your accounting equation, assets equals liabilities plus shareholders' equity. So you simply subtract out, and you can find total liabilities in 2001 were $8.5 million, and in 1995 they were $5.3 million. So the change there was about $3.2 million. Then in the next few, they ask you to find the data in the notes to the consolidated financial statements. So these you're going to have to hunt through the notes and figure them out. For example, the amount of work in process inventory, I found that in a table on page 639 as being $1.3 million. Total revenues from unaffiliated customers earned in Europe. This is part of their segment information. I found that on page 649 in a table. The company's effective tax rate, I found that to be 40.9%, and again that was in a table on page 642. The adjusted cost and estimated fair value of investments held in corporate bonds, I found that on page 641, and the cost was $911 million and the fair value was $912. The market price range of common stock in the fourth quarter of 2001, you would typically find stock prices and dividends at the very end of the annual report, and this is true on page 650. I found the range to be quite significant there. You can see from $19 to $34. And then finally in J, the amount of current deferred taxes incurred from non-U.S. operations. So I had to flip back to 642 to that tax information, and I found the current was $366 million and the deferred was $102 million. So that was good practice for you to go through and look at an annual report and look at some of the information. You may want to compare that with another firm. If you have a firm you've invested in or a firm you're working for that has an annual report, you might want to go through and try some of these exercises with that firm and get familiar with how the information is presented and find out what you can learn about a company just by reading the annual report. At this point, you have completed 2/3 of the information in this course. You are ready to take your second exam. Your second exam covers the modules 11 through 20. It consists of 25 multiple choice questions and about 4 problems. So as soon as you're ready to take that exam, if you'll notify me, we'll make arrangements for you to do so.